Think your credit score is standing between you and your business dreams? Maybe you've been rejected by banks so many times you're ready to give up? Well, get ready, because I'm about to show you exactly how to get the funding you need, even with less than perfect credit. And trust me, your options are better than you think. First, let's talk about what we mean by bad credit. You know how personal credit scores range from 300 to 850? Well, business credit scores work a bit differently. They go from 0 to 100. Here's what you need to know. If a lender is looking at your personal credit, anything below 600 might raise some eyebrows. For business credit, a score under 50 could make things tricky. But don't worry, we've got solutions for both situations. Your personal credit report is a comprehensive document that tells your financial story. It includes everything from your payment history on all your accounts to how much of your available credit you're currently using. The report also shows how long you've been managing credit, the different types of credit you've used over time, and any recent applications you've made for new credit. Your business credit report tells a different but equally important story. It provides detailed company background information and tracks how well you've paid your vendors over time. The report also includes any public records like liens or bankruptcies, shows how you're managing your business credit cards, details your banking relationships, and lists any UCC filings that might affect your business. And here's something many people don't know. You actually have different business credit scores from different bureaus. The main ones are Dun & Bradstreet's Paydex score, Experian's IntelliScore Plus, and Equifax's Business Credit Risk Score. Each one looks at slightly different factors, which is why it's important to monitor all of them. When you don't keep your business and personal finances separate, you're setting yourself up for some serious challenges. Your personal expenses could end up limiting your business's ability to borrow, while your business debt might make it harder to get personal loans or credit cards. You'll likely miss valuable opportunities to build your business credit, and come tax season, you'll find yourself facing a complicated mess trying to sort everything out. Perhaps most importantly, mixing personal and business finances could compromise the legal protections that your business structure is meant to provide. Let's dive deep into each funding option, starting with traditional bank loans. Yes, these are harder to get with bad credit, but not impossible. Banks typically want to see at least 2 years in business, minimum annual revenue of $100,000, a credit score above 640, and collateral to secure the loan. But don't worry if you don't meet these requirements. That's where alternative lending comes in. This option deserves a deeper look. Let me break down exactly how it works. Credit limits typically range from $10,000 to $250,000, with interest rates starting around 8%, but can go up to 24%. Repayment terms run from 6 months to 2 years, and you can withdraw funds as needed, only paying interest on what you use. Here's a real-world example. Let's say you get $100,000 in line of credit at 12% APR. You draw $50,000 for inventory. Your monthly payments might be around $2,300 over 24 months. But the remaining $50,000 stays available for emergencies or opportunities. These loans work differently. You get a lump sum up front and make regular payments. The loan amounts range from $5,000 to $500,000 with terms from 3 months to 3 years. You'll make daily or weekly payments instead of monthly, but you get a quick approval process, often within 24 to 48 hours, and there's less paperwork than traditional loans. Let's talk about some creative financing options you might not have considered. With invoice financing, you can get advance rates up to 90% of invoice value, with fees typically 2 to 4% per month. There's no long-term commitment required. Funding is available within 24 to 48 hours, and your customer's creditworthiness matters more than yours. For merchant cash advances, funding is based on credit card sales volume with daily repayment based on sales percentage. Typical factor rates range from 1.2 to 1.5. There's no fixed monthly payment, and it's flexible during slow seasons. Let's talk about SBA loans. Yes, they're possible with less than perfect credit. The Small Business Administration offers several programs, including SBA 7A loans, which are the most flexible option, CDC and 504 loans for major assets like real estate, microloans up to $50,000 for smaller needs, and disaster loans for businesses affected by disasters. While these typically require better credit, there are ways to qualify through strong business performance, solid collateral, a detailed business plan, personal guarantee, and strong industry experience. Different industries have different financing options. For retail businesses, there's inventory financing, point of sale lending, and store improvement loans. Service businesses can look into equipment leasing, working capital loans, and professional practice loans. In manufacturing, you might consider equipment financing, factory expansion loans, and raw materials financing. Now let's get really specific about your application needs. You'll want to gather your business and personal tax returns from the last 3 years, bank statements from the last 12 months, profit and loss statements, a balance sheet, accounts receivable, accounts payable, business licenses, a solid business plan, and personal financial statement. Let me share some advanced strategies for building business credit quickly. Start by registering with business credit bureaus. Get a DUNS number, register with Experian Business, and set up a business entity. Then establish trade lines through store credit cards, vendor accounts, and a secured business credit card. For monitoring and maintenance, set up payment reminders, keep utilization under 30%, check reports quarterly, and dispute any errors promptly. Here's a comprehensive system for managing your loan. Create 3 separate accounts: one operating account for daily expenses, a revenue account for incoming funds, and a loan payment account for debt service. Set up automatic payments when possible, keep buffer funds for variable payments, and maintain an emergency fund for tight months. Let me share some real examples of businesses that succeeded despite credit challenges. Take Sarah's Bakery. She started with a 540 credit score, used equipment financing to start, built to a 720 score in 18 months, and now has multiple locations. Or look at Mike's Auto Shop. He began with invoice financing, graduated to a business line of credit, and now qualifies for traditional bank loans. Before we wrap up, let me share some critical mistakes I see business owners make all the time, so you can avoid them. First, don't wait until you're desperate for money to start applying. Lenders can sense desperation, and it's much harder to negotiate good terms when you're in a rush. Start building relationships with lenders before you need them. Second, never mix personal and business expenses. I can't stress this enough. Even if you're just starting out, get separate credit cards and bank accounts for your business right away. This makes everything clearer for lenders and helps build your business credit faster. Third, don't forget about local resources. Many business owners chase online lenders while ignoring great opportunities in their own backyard. You should check out local credit unions, some community development organizations, any regional economic development agencies, local business associations, and Chamber of Commerce programs. Let's talk about long-term strategy. Once you've secured your first business loan, start planning for the next stage of growth. Here's what that looks like. In the first few months, you should establish vendor accounts. Then during months 4 through 6, apply for a business credit card. So you can use months 7 to 12 to build payment history, which means by year 2 of building credit and trust, you'll be ready to apply for larger credit lines. You'll want to set up a regular financial review schedule. This means monitoring cash flow weekly, doing monthly expense analysis, checking your credit quarterly, and reviewing your financial strategy annually. The journey to better business credit isn't always easy, but it's definitely possible. Stay focused on your goals, follow the strategies we've discussed, and keep building your business one step at a time. Remember, every successful business started somewhere. Your credit score is just a number. It doesn't define your potential for success. With the right approach and persistence, you can get the funding you need to make your business dreams a reality. And here's one final thought. The best time to start improving your business credit is right now. Don't wait for the perfect moment. It won't come. Take one small step today, whether that's checking your credit report, separating your business and personal expenses, or reaching out to a local lender. Your future self will thank you for starting this journey today.